This is the 10-Minute Contrarian Podcast. This is VP. We are a solutions-based podcast, diving into the world of contrarian investing and alternative finance. You can find us hosted on the No Nonsense Forex YouTube channel, NoNonsenseForex.com, and podcast players everywhere. Episode 171 is brought to us by Bybit, and the traders are back. It did not take long, but the entire market's going up, and you would have to be pretty bad at trading not to be making money right now. So if you even have a small edge in trading, you need to be out there and you need to be doing it on Bybit because you have one of the world's largest crypto platforms and you have giveaways and airdrops and promotions and all sorts of stuff that you just don't get this level of elsewhere. So go down to the show notes, click my link, read the blog, see if Bybit is for you. It probably is, and then click the link at the bottom of that blog and get yourself started because with Bybit membership, has its rewards. It is the 10-Minute Contrarian Podcast, and we're kind of in a period, as far as programming goes, where there's not a lot to talk about. We've mentioned this in the past. You know, when the markets that we invest in are going up, then there's not much for me to say because we like to buy things when they are cheap. I like to present opportunities to you when they are cheap. You know, and our markets are doing really well. Not quite take profit well, at least not for me, so there's not even much to talk about there. Now, we do have the election coming up. There is an election episode that I'll be airing sometime in October. But what I thought I would do this time is there is maybe 2 or 3 episodes here that we can talk about as it pertains to us investing after we have already made our money in what we are investing in right now. Because once this happens and once it all plays out, we might end up in a situation where there's just not a lot of asymmetry out there to be had anymore. Like contrarians, we really are in a golden age of asymmetrical investing because think about it. After the recession already hits, we can reasonably expect, Bitcoin and precious metals and energy to already be at really high prices. And I would actually expect the dollar to be high as well, especially if the whole dollar milkshake plays out, which I do expect it to. And if you're not sure what that is, it's an easy lookup. Then the one main thing that should be cheap after this whole thing washes out is stocks. And we're going to want to take our fiat cash, which is now at a very high value, and sell it for things which are cheap. At this point, you can really start to do what most people just don't have the money to do, and that is build up a real nest egg. For whatever purpose you want to build it up for, whether it is retirement or you want to do some of it for retirement, or you just want to buy something really nice, or if you just want to live off the dividends that you make from this account. It is an absolute luxury that most people will never get the chance to have. But if our asymmetrical investments that we're involved in right now do what we expect them to do, well, then the majority of you should be, fortunately, I don't say fortunately, you make your own luck, but you should be in this position. And this is a really beautiful thing. Because even if it doesn't make you quote unquote rich, it will make you a lot more financially free. And I cannot tell you what being financially free does to the rest of your life. So let's get excited about that. And let's start planning ahead for how we're going to handle this brand new nest egg that is now in front of us, or a larger nest egg than we currently have right now. So we may as well talk about these concepts now because, let's say, the recession doesn't happen for a little while and, it's long and drawn out and 3 or 4 years go by. This podcast may not be in existence anymore. So let's go ahead and put this on the record now so you can reference it anytime you like. Now, what we're going to talk about is a concept called the Rule of 72. And this is a concept, it's not completely underground or anything like that, but it's not really popular either. And I feel like it should be. So what it is a tool to determine how long it would take you to double your account should you be able to compound that account at a certain rate. So if you're a little confused, stay with me, I'll explain it further. Now, the way you do it is take a number to where you think you can grow your overall nest egg on average per year. So let's say you can get a 4% return. So at this rate, you're being pretty conservative, probably going into T-bills and bonds and things like that. Because remember, when you take losses throughout the year, if you have a year that gives you a negative, this does factor in to your overall gains. So let's just say 4%. How long would it take you with compound interest to double this account? And what you will do is you will take the number 72 and divide it by the number in question, which in this case is 4. And doing it this way will not give you a perfect answer, but it will get you pretty close. So if you do the simple math here, 72 divided by 4 is 18. It would take you 18 years to double your nest egg. Now from here, every percentage point you add on is going to make quite a difference. It's going to start making less of a difference as we get higher and higher. But for example, if you were to take this 4% average return on your account and find a way to bump it up to 6, so a 2% increase, that's all we're doing here. You have now taken the time it takes to double that account from 18 years all the way down to 12. You want to bump that number from 6 up to 8? 72 divided by 8 is 9. And this is pretty exciting. You're getting an 8% return on your account. You can double that in 9 years, and then in another 9 years, you can double it again. And remember, hopefully we will be catching a market in its recovery phase, and if that is what's happening, then getting numbers like this should not be very difficult. And contrarians, this is why we like dividend stocks as much as we do. Because if you can just get a stock with a reasonably good dividend, which is about maybe like 4%, for example, then this is nothing more than a bonus that gets added on to the return you already got for the year on that stock. So if you get a 10% return, for example, well then congratulations. Now it's a 14% return. Did you take a 2% loss on that stock for the year? Well, don't be so sad. Now it's actually a 2% gain. When it's time, we will be expounding on the benefits of dividends when it comes time to. But let's just a sneak preview there. It's awfully nice to have. There's a reason why they are as popular as they are, because you're starting to see every little percentage point does make a difference here. So if you're going to sit there and give me percentage points for free, well then yeah, as long as you're not cannibalizing growth or not doing it too much, bring it on. So if we keep going up by 2, a 10% return, obviously 72 divided by 10, that's 7.2 years. If you bump that up to 12%, now we're talking about doubling your account every 6 years. Think about that. Doubling your account. Let's say you have $200,000 that you have made through this last investment cycle, and you can double that every 6 years. Remember, even if you're lazy, the American stock market has averaged anywhere from 11 to 12% return every year. So if you just throw it in the SPY ETF, which does pay a 1% dividend, by the way, then something like this is quite achievable. Now, will we be in that type of environment by the time this recovery hits, or will it become more of a stock picker's market? That's a big question we're going to have to ask ourselves when it comes time. We're in the dying moments of the best period of stock investing that the world has ever seen. Will it continue to be that way? Will we have a soft landing or no landing and hit the ground running and get right into this new amazing cycle? Maybe. I don't think the odds are in our favor there. But just know that numbers like this are not super lofty. The S&P 500 already gave this to you, for Christ's sakes. What I think we should be asking ourselves is, how much more can we tack on to this 11 or 12%? And how much sooner can we double our accounts? Again, this is going to sound absurd to your average person that doesn't have a lot of experience in this field. But we, contrarians, have innate advantages here that most people do not have. And I will be speaking about those in next week's episode. Now, one thing I did want to say while we're here, let's say you can bump that up to 14%, which is really great. Remember, Bernie Madoff became Bernie Madoff because he was able to outdo the S&P 500 by 2 percentage points. That's a big deal And people have gotten on my case before about mentioning Bernie Madoff because he's a huge scammer. They're missing the point. The demand that guy caused from all of these ultra-rich people simply by getting himself from 11% and change up to 14% made his company billions. But let's say, for the sake of argument, that you can get yourself 14%, you could essentially live off of 7% of that and then still maintain a 7% return, which you can compound in that account, which by the law of 72 would take you just over 10 years. And by the way, if you would like a nice little Rule of 72 cheat sheet, I will include one down below in the show notes and in the YouTube description. It includes the basic Rule of 72 numbers and then the exact numbers as well. So if you want, you can print it out and replace all the girly posters up on your wall with something that's even more exciting. We don't judge here. But to close the show, I want to take the excitement here and sober you up a little bit, because we have to come back down to reality, because things like taxes, for example, are a reality. And inflation is a reality that affects everybody. So, those things are going to bite into your percentage every year. So it's not just blue skies. It is for some people. Now, nobody can escape inflation, for example, but you can do what we've talked about on this program and live in a place that is a lot cheaper, so inflation barely affects you. For example, when inflation was hitting really hard a little while back, where I was living in Mexico at the time, and our inflation there was 11%. And people were asking me how I was coping with it. I'm like, well, I signed my apartment lease before inflation started hitting the way it did, so that doesn't really affect me. And my grocery haul, which would cost about $75 in the U.S., only cost me $20, and now it costs me a little over $22. So yeah, I'm doing pretty good. It's not really affecting me a whole lot here. So you want to talk about things that compound. When your savings month to month compound the way it can compound by simply getting out of your expensive situation and moving into a better one, we won't even talk about that, but that is a really good way to mitigate things like inflation, for example, and just high cost of living. And if you are a non-U.S. citizen and you are in a place that has high capital gains taxes, without giving up your own citizenship, you can simply get residence in a place like Paraguay, which is not going to be cheap forever. What a lot of non-U.S. citizens do is they get their residency there, set up an Interactive Brokers account, and then immediately start trading and investing with no capital gains tax, because you only get taxed on the business you do inside of the country. So I just picked a random country to where I have a good listener base. So I picked Germany, and the capital gains tax for Germany is 25%. So if you were to take that 25% and move it down to zero, that's very, very impactful, especially long term. Putting a little bit of effort in now to lock in rates like that for your future is absolutely worth doing. And by the way, as an aside, the number 3 language spoken in Paraguay after Spanish and their local Guarani language is German, believe it or not. So in the future, if you just want to sit on your hands and let these taxes eat away at your account year after year after year and let that compound, well, then you be my guest. But just don't ever say that I didn't give you alternatives here. Now, if you are a United States citizen, unless you renounce, which I don't recommend anybody does, we are not able to do something like this. Believe me, I have explored almost every avenue here myself. I thought I had it for a moment, but I was wrong. We are just going to have to pay capital gains for the rest of our lives. Now, there are ways to mitigate this, however, and I recommend you do that. First is the obvious one. You can get them down from where I think 38% now down to 15% simply by holding a security for over a year. or really anything over a year. I think this applies to Bitcoin and things like that too. But what you can also do is trade through an IRA or a Roth IRA. I'm not going to give a master class on these two things because I don't know a ton about them because they just don't apply to me yet. But I know people who are in their 20s that are trading through IRAs because if you trade through IRAs, there are no capital gains because it is a retirement account. And then if you want to withdraw early from that account, you simply just pay the penalty, whatever that is. And if you do it right, the money you would be paying on that penalty is normally going to be a lot smaller than what you would have been paying if you got taxed on that account. Or you can do the half in, half out strategy, to where you have two accounts. One normal trading account, and then an IRA account that you might be saving for retirement or are okay with withdrawing, at some point and eat the penalty. But you're trading half of your money in a normal account and then half of your money in an IRA account. At least you can cut your taxes in half that way. Because, the main thing I wanted to get across to everybody in this episode is that percentage points really matter. They make a really big difference. And I don't know how much time you have to get yourself set up, whether it's going to be 6 months or whether it's going to be 4 or 5 years, but I really recommend you start looking into things like dividend stock trading, to where you're simply getting percentage points for free. And what's going to be a little bit harder, but you can do it, get yourself set up on the elimination side. How can I gain percentage points back this way? Instead of just sitting there and taking it and eating it because I was too lazy and or too afraid or too much of an excuse maker to do the work ahead of time when I should have. Because contrarians, I'm going to say it one more time, percentage points, even individual percentage points, make a huge difference. And sadly, there are not a lot of us out there with the foresight to do the things we need to do now to make sure that we have access to all those little extra percentage points and allow them to compound year after year for the rest of our lives. So on the surface, it does seem a little bit eccentric. It does seem a bit crazy. But believe me, you are going to want to be early.